Hi everyone, welcome back to another episode of Providend's Money Wisdom Podcast. I'm your host, Isaac, Associate Advisor at Providend. Join with me today is Lim Choon Siong, who is an Investment Research Analyst at Providend. Hi Choon Siong.
Hi Isaac, thank you for having me.
Yeah, thank you for coming today. Okay, so in today's episode, we are going to be talking about what happened to the market in the first quarter of 2023. So, Choon Siong, how has the market been since the start of the year?
Okay, so overall, quarter one has been very volatile. At the start of the year, January was very good for the market. China opens up and the equity market actually climbed 5 to 7%. Market sees rate hike momentum also slowing down. So yields fell and bond went up as well. So in January, we are looking quite good for both bonds and equities. Now in February, there was the opposite actually, because January inflation were actually higher than expected. Core CPI came out at a 5.6%, while consensus expectation was actually at 5.5%. So the bond gains were practically wiped out. There was gain from January actually, and equity paired its gain as market price in a higher rate hike probability. So in March, we all heard about the banking crisis saga. At the start of the month, stocks got dragged down, but in the financial sector where small and mid-sized banks fell. But yield fell and bond climbed because now the market thinks that the Fed might need to slow down or even stop on hikes to prevent a hard landing and be gentler on the liquidity tap. Now, near the end of the month of March, equities end up higher as stocks climbed and more than offset the fall contributed by the small mid-sized banks. So, year to date as of March, actually, equity indexes actually on average went up nearly 7%, while bonds on average actually went up 3%. And overall, it is quite positive right now.
Right, so Choon Siong, just now you mentioned that in March there was a banking crisis.
Yeah.
So what exactly happened, and more specifically, what happened to Silicon Valley Bank?
Okay, so just to give a brief history of Silicon Valley Bank and how did it collapse. First of all, right, we need to know that Silicon Valley Bank, they have a very quite concentrated clientele, mainly tech startups companies that were backed by venture capital firms. So during early 2020, there was an explosion of deposit growth for Silicon Valley Bank following the pandemic because of the quantitative easing. So you can think of the quantitative easing as pumping money into the economy to prop it up because of the lockdown, everything is slowing down. So to give an idea how much the deposit grew, right? Actually, Silicon Valley Bank's deposit went up by 220% between 2020 to end of 2021. Now, while average banks actually grew during this time period at only 26%. Now, as the Fed tightens in 2022, liquidity starts to dry up, and these startup clients started to withdraw their deposits. On top of that, Silicon Valley Bank used the deposits to buy long-term bonds and security. What this means is that Silicon Valley Bank will have trouble meeting withdrawals demands, which is exactly what happened. In fact, only 7% of their assets is in cash compared to the industry average of 13%. Now, plus, longer-term bonds are more sensitive to interest rate changes. And what this means is that when interest rates rise, they will have a high mark-to-market losses. Now, finally, on 7th of March this year, Silicon Valley Bank have no choice but to announce that they have to issue more equities and sell their bond securities to meet deposit withdrawals. The announcement, right, actually triggered the venture firms to inform their startups to withdraw even more money from the bank. Now, this lead to what we call the bank run and eventually the collapse of Silicon Valley Bank. Now, to summarize, what this means is that the reason for the collapse is because of a concentration of clients in the startup space as well as bad risk management.
Right. So you mentioned that it seems quite specific to Silicon Valley Bank, quite idiosyncratic in that sense. However, there's a lot of headlines that mention about a contagion effect. So what does this mean, and do you think that there will be a contagion effect for the other banks, especially those globally systemic banks?
Okay, so let me just explain what does contagion effect actually mean. Basically, it's a phenomenon in which the failure of one bank or more can spread fear and panic among depositors of other banks, leading to a wider and more severe bank run.
Right.
Now, during a bank run, right, depositors rush to withdraw their funds from a bank, usually because they fear that the bank may not be able to meet their withdrawal request if too many people try to withdraw at once. So if the bank is limited to, normally if it's limited to one bank, the bank can often use its reserve or seek assistance from the central bank to meet the withdrawal and restore confidence. But if the bank run triggers a contagion effect, depositors of other banks may also start to withdraw their funds out of fear, and their bank may be the next to fail. Now, this is what we call a systemic crisis in the banking system. And policymakers are very worried about this kind of systemic crisis, which is why when you see that there are the US banks failing, right? The Fed actually came in and quickly tried to calm the investors. Yeah. Now, in the current context of our US banks, we see the collapse of Silvergate, Silicon Valley Bank, and Signature Bank. Just to give a sequence, right? Silvergate Bank failed, and 2 days later, we see the Silicon Valley Bank starts to unravel itself, and following that, it was a Signature Bank's collapse. So both Silvergate and Silicon Valley Bank were due to a bank run, which we can view as not really a contagion effect type of bank run, because their common denominator was concentrated clients. In Silvergate's context, just now I did not mention, is that their clients were concentrated in crypto startup clients, and we know that during the past year, the crypto actually fell, and there was this FTX crisis that caused a lot of worries on cryptos. So when these two banks actually failed, right, it raised a worry that similar sized banks and with a similar kind of clientele would actually fall as well. Now, Signature Bank was you can consider that as the first victim of this contagion effect, because everyone started to worry that because Signature Bank has a similar concentrated client of a crypto clients, and the clients started to withdraw a lot of money, leading to a self-fulfilling effect.
So in a way, it's a contagion between, like, let's say, Silvergate and Silicon Valley Bank, but it seems like it's contained.
So Silvergate and Silicon Valley Bank is more an isolated kind of event, but the failure of these two banks subsequently raised the concern of a contagion effect to similar sized banks, and the Signature Bank was the first that got impacted by these two failures. Yeah.
Right, but you said similar sized bank. However, Credit Suisse stock plummeted, and UBS has taken over the bank. So as compared to Silicon Valley Bank and First Republic Bank, Credit Suisse is a lot larger and more established and can be classified as a systematically important bank. So is this something that we should be worried about? It seems like the contagion effect has now affected the larger, more established financial institutions.
Okay, from a depositor standpoint, right, the straight answer is that there's nothing to worry about. The central banks, regardless US or Swiss, were quick to take action when the crisis occurred. If we look at the US banks, Jerome Powell actually came out and said that all US depositors are safe, and he will use whatever tools to ensure that. The Swiss National Bank actually provided a lifeline to Credit Suisse, $54 billion, to shore up their balance sheet and depositors in confidence. So now, beyond the depositors, we also have shareholders and bondholders. Now the question is, are they safe? So before that, let me just explain the meaning of a systematically important bank. So a systematically important bank is a financial institution whose failure could pose a significant risk to the stability of the financial system and the broader economy. These banks, we would deem them as too big to fail. But because of this importance of this systematically important bank, right? Regulators and policy makers closely monitor them and subject them to more stringent regulation and supervision than other banks. These banks, they will require these banks to hold higher capital and liquidity buffers and undergo regular stress testings. To give an example of systematically important banks, think about JP Morgan Chase, Bank of America, Goldman Sachs in US. And in Europe, you can think of like HSBC, Barclays, and Royal Bank of Scotland. Okay, now we go back to Credit Suisse downfall. It is not I wouldn't say it's a sudden plummet of share price to per se, because the downfall has been many years in the making. Okay, from being charged with bribery and fraud in the Mozambique tuna bond scandal, where the officials actually, the Credit Suisse actually bribed the officials and they were fined for it, to losing billions of dollars of clients' money on the Green Seal funds, which they marketed as safe, and also having a too concentrated and huge exposure to Argios capital management, causing the Credit Suisse company to lose $5 billion. So Credit Suisse has been experiencing many scandals in the past few years. The Swiss, in fact, because of this, right, they have eroded their credibility. Just last year only, their deposit fell by 40%, which is roughly about 123 billion in 2022. And the fall of the banks, the US banks, only acted as a catalyst for the Credit Suisse downfall, because investor sentiment actually caused the credit crisis and kind of drove the Swiss bank share price down. And on top of that, there was actually an interview with one of Credit Suisse's largest shareholder, the Saudi National Bank, and that actually caused the most fall in its stock prices, because when they interviewed the chairman of the Saudi National Bank and asked, right now Credit Suisse is having a liquidity issue, would you support them in this case? But the chairman of the Saudi National Bank actually mentioned that absolutely not. In fact, that caused the plummet in stock prices. The fall in stock prices, right, is not big. Over the years, it's not caused by just these few incidents. To give an example, right, dating back to 2008, right, versus the current share price now, Credit Suisse current share price before the crisis, right, is just 3% of what it was back in 2009. So it has fallen over the years because of all these scandals, and not just because of these few recent happenings.
3% of the total market capitalization.
Yeah, 3% of the total market capitalization during 2009. So you can imagine how much it has fallen during that time. So in summary, right, we first look at, the common denominator for Silvergate, SCB, and Signature Bank are because they have concentrated companies, while Credit Suisse collapse was due to their loss of credibility, and the US banks fall, right, just helped to catalyze their downfall. So aside from these isolated cases, right, now because of the more stringent regulation I mentioned just now, right, the health of US and Europe banks' balance sheet is actually in very good condition. To give an example, right, Europe banks on average have a liquidity coverage ratio of 160%. Regulatory requires them to have a 100% requirement. They have the ability to meet their short-term obligations, and it makes it so I don't see any anything right now that we should be worried about. Yeah.
Right. So you mentioned that most US, or rather the larger banks in US and Europe. Okay, so let's talk about Singapore banks. So just to sum up, should I be worried about my money in Singapore banks? Should I withdraw everything? Is my money safe?
Our Singapore banks have even stronger balance sheet. They are very well capitalized at this point, and in fact, right, they are ranked amongst the most strongest and safest in the world. So Also, we need to understand that, say for example, like for the US banks, right, their client base is mostly startups. For Singapore banks, right, especially the trios, OCBC, DBS, and UOB, right, they are mostly large corporates as well as more high net worth clients. Therefore, the likelihood of a sudden bank run from all these large corporates and clientele is less likely compared to like right now where the clientele of startup firms are facing dry liquidity, right, and sudden withdrawal of their money from there. Now, on top of that, right, just now I mentioned that Silicon Valley bank deposits actually tripled, almost doubled to tripled over the past 3 years. But our Singapore banks actually rose only 22% over these years. The sudden increase of this Silicon Valley banks deposit only show that the deposits come in fast and it will go fast, while the Singapore banks deposits are more on the stable rise. One more thing to note is that the Silicon Valley Bank, right, majority of their deposits were invested in securities and bonds. On Singapore banks, they tend to earn a higher profit from these depositors using loans. And with the rise in interest rate, right, these loans that are given to the loaners and all that are all based on majority are based on floating rate. This means that they can transfer the higher interest rate burden to the clients.
Thanks, Choon Siong. So inflation has been dominating the headlines since the last year, but it seems to have taken a backseat due to this banking crisis. So do you have any updates about inflation, and has it been coming down since the start of the year?
Okay, right now it appears that the problems related to the banking crisis are actually now easing. And the attention is now shifting back to inflation and interest rate hikes. So if we want to look at inflation, let's say we use US inflation rate as a guideline. Just now I mentioned, right, in the January inflation rate has been ticking up the first time in 4 months. So that was actually inflation being worse than expected. In February, the inflation has been in line with expectation. Now in March, they just released yesterday, March data. The inflation rate was actually quite favorable. It was below consensus. So how will the Fed and the market interpret this? Interestingly, right, both parties seem to have a disagreement on the path of interest rates. If we look at the Fed's last monetary policy, they are forecasting a 5.25% of interest rate as of end of the year. While based on the market pricing of interest rate probability, it looks like the market is seeing a range of between 3.75% and 4.5%. What this means is that the market is thinking that the Fed might be forced to reverse its interest rate, given that the banking crisis might actually cause a worse than expected recession.
Right, so is it a situation where the Fed is caught between a rock and a hard place? Like if they cut rates to try to fix the banking crisis, they might lead to them not being able to slow inflation down, and vice versa. So do you think that this is something that could spell at least more volatility for the rest of the year?
What we are looking right now is that there needs to be an alignment as things unravel. To further explain, right, if we think about right now the dissonance between the Fed expectation of interest rate at the end of the year and the market, if inflation gets worse, the Fed might continue to follow its forecast and raise interest rate to 5.25%, for example. The market will then have to recalibrate the prices, and we will see we're likely to see both bonds and equities fall in that sense. However, if the market is right that there is the inflation gets better and the recession might be worse than expected, then the Fed might need to force their hands to reverse interest rate, and we would see bonds perform better, and market could be going either ways. Yeah.
Right. So I'm going to put you on the spot here. I know at Providend we don't make forecasts. Just maybe your opinion. So would the Fed be able to achieve the so-called Goldilocks, just right kind of policy, like they can manage to reduce inflation but not crash the economy? Do you think that is a possibility, or is it a pipe dream?
First of all, right, if we look at the recent data that's being released, right, things are quite, I would say, rosy, because if you look at inflation rate in March that was released yesterday, right, it was actually better than expected. On top of that, recently they have actually also released the unemployment rate and job growth. So job growth actually was below expectation, but unemployment rate was actually came down by 0.1%. So what we see is that, yes, job growth has slowed down, but the unemployment rate is still looking good, and inflation is now seems to be ticking down as well. So based on this information, right, it does seems that the economy seems to be is slowing down, but not as bad as we expect, and as well as the inflation rate is also slowing down as well. That means that the previous interest rate hike might have some impact on this as well. So yeah.
Right. So it seems like we're heading slowly but surely in the right direction, and hopefully Jerome Powell will be able to get the sweet spot and not cause the economy to go into a deep recession while he's trying to combat inflation. So it has been a very volatile first quarter of 2023, and what we always tell our clients is to really hang on to your seats and stay invested, because it has been quite a roller coaster, but my equity markets is still up despite all these talks of crisis, talks of inflation, recession. Not to say that stocks will only go up from here or that it wouldn't plummet, but it just really goes to show how hard is it to predict what stocks will do. Historically, it makes sense to know what's going on, but also to hang on to your seats and just stay invested.
Yes, you're right, exactly, because we wouldn't be able to time the market and know exactly what will happen, but staying invested would definitely be the best way to go.
Okay, so that's all for this week's episode. Thank you so much, Choon Siong. And to all our listeners, I hope you enjoyed our Q1 market review. If you like this episode, please follow our podcast and follow us on social media for similar contents. As always, thank you for listening, and I'll see you in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.